Hey everyone, hope you're having a good day. My name's Andy, channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics and/or financial topics. So we're going to dive right in, take a look, see what's going on, and I'll share my opinions as we go through it. So if you want to follow me at Finance, you want to join our community, we have a question and answer session that's occurring today, 7 a.m. Mountain Time. That's when this video is being released. And it is being recorded, and I'll upload it to the website if you guys miss it. Discount coupon code is still active. So Clint Fourier, whatever you pronounce his name, it says, if you could pick your age and net worth combo starting today, what would you choose? 20 with a net worth of 500,000, 30 with 5 million, 40 with 50 million, 50 with 500 million, and 60 with 5 billion. Well, what I would choose is I would choose the age of 20 with the net worth of $500,000. That's what I would choose. And that's pretty good for a 20-year-old to have 500,000 bucks. I think that's actually pretty good. You could always make money. You can't turn back time. So I would choose 20 with a net worth of 500,000. In fact, I would choose 20 with a net worth of zero. Even against those other options. And once you hit a certain level, guys, I mean, I don't know. To me, it doesn't really matter once you hit a certain level of money. If all your basic needs are met, you've got a decent area that you're living in. I mean, you don't need much more money than that, I don't think. I don't think it's going to increase your happiness proportionally with the money increase. So I know there's a lot of people they 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 want to drive a Lamborghini. They want to drive a I don't know what their dream car is. Who knows? I'll just say this, guys. They're all made out of metal. They all have plastic interiors for the most part. If you really break down a lot of these cars, they're all made pretty similarly. And then if you really want to have fun, you don't need a $500,000 car. I mean, you can have fun driving a crappier car and just driving it at the limit, and it is so much fun. So, I mean, the things that people aspire to have, once you get them, it's not going to change your life anyway. So, I'm going to go with 20 with a net worth of 500,000. I'd even choose that if it was a net worth of zero. Now, if it was a net worth of like minus $2 million or something like that, I'd have to think about it. I wouldn't want to have to pay off all that debt um, if the choice was that. Cuppy says first official readout from the Trump Xi trade. Real progress. It says, I demand that you buy more from America and fix this trade deficit. He says, great idea. What do you guys produce that is cheaper or better than what we produce? He says, we've got soybeans and maybe some LNG. You guys really are an emerging market with aircraft carriers. I hate to say it, but that's kind of true. I mean, it really is if you think about it. I thought that was funny. Unusual whales, fake it until you make it. Millennials are obsessed with looking rich. Wells Fargo study shows per Fortune. I was born right on the cusp of being a millennial, so I'd be maybe considered the oldest millennial. I was born in 81. So that is definitely not me. I am exactly the opposite. I probably have more traits of a Gen X than a millennial. And I do feel a little bit like an oddball being with other millennials on the younger side. So I don't know. I definitely am not obsessed with looking rich. I dress pretty, so whenever I don't wear anything that has names on it unless it's something that is a reflection of like, I've got this Finding Value shirt, but all my other shirts are all blank. I don't want to project or advertise for any company. I don't own any Nike stuff outside of, no, I don't own any Nike shorts even. I own no Nike shoes. Um, I have blank, shirts, just regular like black and white shirts for the most part. Some of them have little like pockets on them just because I bought the wrong one. And I hate spending time at stores, so I just pick whatever's off the shelf real quick, and I don't really look that much, and then I just get the right size. So again, I am the exact opposite. If you looked at me, you'd probably say this dude is so poor, it's unbelievable. Look at his car; it's just a POS. And I'd be like, yeah, it's fine, whatever. But there's benefits to driving a crappy car. You can park it wherever. You pay less in insurance, less in registration, less in tire cost, less in gas because it gets good gas mileage. If somebody nicks it, dents it, whatever, doesn't matter. It's already an old car and it's got 200,000 miles on it. So I am the exact opposite of this quote. I am literally the yang on this yin here. I mean, yeah. Lance Lambert says the total number of completed new homes that remain unsold is at its highest level post July 2009. There is some slack in the single family construction market, and that is changing. It's changing rapidly. This is number of unsold completed homes for sale. Now, most of the inventory is in new homes. It's not in existing homes. And it's a really weird dynamic that I don't think we've ever seen in history before. And what does that mean? We've never had existing home inventories at really low levels and have new home inventories at really high levels. It's obviously having an impact for affordability. So affordability is having an impact on the housing market. The problem is we haven't, I don't think we've ever seen this in history, this divergence as big as it is, because we would almost always see that these cycles are driven by the real estate market and interest rates are driven by the real estate market. So the pace setter, the interest rate pace setter for monetary bank lending was interest rates. And the pace setter was the inventory levels. We are not, this is not connected. Interest rates are not connected to the real estate market anymore. This is something big. That's a big disconnect, and it's bad, and it deals with debt. So fiscal spending is driving this train. Inflation from fiscal spending is driving it, and interest rates are moving with that fiscal spending and the debt problem. And the reason I can say that is because we have a disconnect between existing home inventories and new home inventories, and this is definitely not the driver of it. The real estate market's not the driver of interest rates. Value Seeker said this is copper. So copper adjusted for money supply had so far a very good month, climbing along its long-term support. Remains now to break the resistance at around $4.60. That chart looks ready to go. So whenever you get a bottom like this, and you got a nice strong resistance level, and you've got your lows coming up like this looks really good for a break. I really do like this past month where we have this big green candlestick and we don't have a ton of selling pressure. This thing looks ready to go. Looks ready to go. Captain Foresight says crude continues to track at the bottom of the 5-year cloud. Look at this thing, man. We're like ready to break out of crude oil stocks to the downside for inventory. You know what this means? Oil prices are too low because we need to have oil prices to come on up for us to bring this crude oil stocks up. But we're in this weird dynamic, guys. I don't understand this. We've got all of these things that are like breaking apart in history. The real estate market, it's not driving interest rates. So something else is driving interest rates. It's the debt and fiscal spending and all that stuff. We've got crude oil stocks where we got these super low prices, but yet our inventory is falling off a cliff. We've got copper that's just sitting here ready to rip. That looks just good. I just had to say that. But some of these, it's like, what's going on here? I mean, oil should probably be $90 a barrel or something, or more, maybe. It's hard to say. Baker Hughes rig count, right? So we got oil prices going up and natural gas prices going up, and oil count down to and gas directed count down to. What the heck? So natural gas has been working its way on up. Oil just recently was moving, but I'm surprised to see that the rig counts are dropping. Nuttall update. He says oil is based on the Russia sanctions of 1.5 million barrels per day sanctions from the Biden administration as a gift to the Trump administration. Iran went from 400,000 barrels per day to 1.8 million barrels per day. The delta from both Iran and Russia could be up to 3 million barrels per day, though we do not think this will reach this height, though it could be significant. In addition, a recent story about Trump coming down on Venezuela oil, in addition to Russia and Iran. Is he trying to raise oil prices? Is that what Trump's trying to do with these sanctions? Because, I mean, basically, if you take this oil off the market, you're going to eat through the spare capacity that Saudi Arabia has. So, yeah, we'll see what happens there. Josh Young says natural gas prices at multi-year highs and 2 gas rigs were dropped. Yep. The worst long-run return for U.S. Treasuries in the past 90 years. So you can see this is your returns. We had nice big 16% returns. And then we went down, 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 and we are now negative. Negative versus 1960 was the last time we were at like zero. We have some pretty negative moves here for U.S. Treasuries over the past 90 years. This is the 10-year rolling annualized returns. Wow, 10-year annualized rolling. That's a big deal. Money rotation is not going into bonds, I'll tell you that. Luke Grumman says if a twin deficit nation with 125% debt to GDP, like the US, does not keep nominal GDP growth, which is G, greater than rates on its debt, a debt crisis becomes mathematically inevitable. Once your debt is maybe he has his debt less than growth. The only questions are how fast the debt crisis comes and what brings it on. Gold and BTC get this. And he also says, too, and to preempt the inevitable question, China is not a twin deficit country and neither is Japan. And 3, sorry, yes, the last line should read R is greater than G. So if your interest rate is greater than your nominal GDP, you've got a problem. Doing a capital rotation event, here's the last one. So this is what the Nasdaq did, the last capital rotation event. You can see here on the left-hand side of the screen. It fell 83%, it recovered, and then fell 54% during that capital rotation event. We came on up. We had a big pullback here, 38% retracement. But what, in his opinion, it was nasty, but not a capital rotation event. And I would agree with that comment. Um, this is the stimulus overhang pullback, is what I call it. It's still going up, and we're still putting in these gigantic bottoms in commodities. I do think we're getting close for a rotation of this capital rotation event to occur. So I think it's coming very soon. That's your big commodity bull market. What's going to be the driver of it? I'll give you 2 things that will drive it. The number one thing that will drive these big capital rotation events is the price of oil going up. And we do have a recent breakout of oil breaking higher. Number 2, when oil breaks out to the upside, interest rates generally follow that. Now, we have seen a breakdown where interest rates are kind of diverging against some other assets. But historically speaking, interest rates and crude oil move together. Oil moves first, interest rates move with it. This time, interest rates have gone up before crude oil even broke out. And that generally causes capital rotate differently. It's a interest rate. So bonds are already selling off. That's interest rates going up. The second portion is stocks rolling over. And this is the Nasdaq rolling over whenever it does. And interest rates will be the driver of that if we were to get this event. And I think we're going to get this event no matter what. Um, all of the same characteristics are present in this potential capital rotation event right now as it was back in 2000 and in the 1970s. We are also seeing declines in inventories of all these different commodities too, and gold and all these other ones. Sanctioned Russian tankers. A total of 270 tankers have been sanctioned for carrying Russian oil. 68 tankers have been sanctioned by more than one entity. So a total of 270 tankers have been sanctioned. Look at that. Look at that move. Look at all these tankers being sanctioned. Boom, 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 all the way up. Crazy, crazy, crazy. Rick Rule sees a big re-rating coming for Canada's energy sector as Justin Trudeau steps aside. Episode 2. So yeah, I would agree with that. They're super cheap, man. They are super cheap. Love it. I love this sector. Christine Guerrero says sanctions enforcement is very bullish for oil as it could allow for half of OPEC's spare capacity to re-enter the market. That's super bullish because if you do that, then we'll soak up spare capacity probably in 2025. All of it, almost. Because it'll soak up from demand growth and also from these sanctions on some of these countries. Warren Pies. Now this is some interesting data he has here. He says similar story when comparing gold to DXY. In 2024, it's the first year ever where gold was up greater than 25% and the DXY was up greater than 5%. It's really interesting to zoom out and consider the message. So look at where 2024 is. So historically, what this is a dot plot. And what he's plotting is he's plotting gold versus the dollar index annual returns. And what you can see is gold has a lot of returns, big returns, when the DXY falls. So if you look out here on these big returning years, like 80, this is 40% plus return years. All of those returns happened when the DXY went down. That's what this y-axis is. The x-axis, which is gold returns, you can see they're all over here. So when the dollar drops 10%, gold rips. See that? All down here. Now, if you go where gold went down, where gold had a negative year, they were all in the upper left quadrant here. And they were all when the DXY went up. Now, there are a few years, there's an overlap where gold went up and the DXY went up. That's the quadrant over here. There are literally almost 0 times where the DXY fell tremendously and gold also fell. But most of those, like 1990, that was a recession year. 90 was a recession year. 1969, that was right before the commodity bull market occurred. More recession years, 2008, let's see where that's located. 2008 had not very much gold. Gold didn't go up a lot, but the dollar did go up. 2001 is here too. Those are also recession years. 01, 08. Now 2024, look where it's located. Now, if you look at the stuff around us, what's around us? We have 2011, 2016, which was a very similar year to 2024. We have 08, 2001, 2005, 1982, 1980. These are kind of towards the end of peak of stuff. But I thought this was a really interesting chart and how far out we are in relationship to the DXY going up. Here's another one. So this is gold. In 2024, gold was up 28%. The 10-year tips were plus 51 basis points. He says only the 5th calendar year with positive 10-year tips yields and positive gold, 2005, 2006, 2008, and 2023, never seen such extremes. I think he means 2024, not 2023. Here's two broad conclusions. Central banks are driving the run, and this is a secular bull market behavior. So secular bull market behavior means Secular is long term. It's not a 1 or 2 year move. This is like a 10, 20, 30-year move. So there is the outliers. In 2024 is out on its own, it's way out there. So we have two charts that are way out there in 2024 with gold versus the dollar and gold versus 10-year tips yields. This is crazy, 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 crazy. And you can see kind of how these are all broken out. 2000, the year 2000 here, we had negative gold returns and negative tips yield. 2020, 2014, 2021, 2015 was way out here. That was another kind of anomaly there. Then we can see a whole bunch kind of clustered together over there. 2011, another outlier. 2002, 2020. Yeah. Tavi says this chart is concerning. When adjusted for money supply, Nasdaq is currently retesting the levels reached during the tech bubble of 2000. So, yeah, we're right there at that exact moment. So we are in a bubble, guys. It's just when is it going to pop? We are in a bubble, no doubt. No matter how you measure a lot of this, when you measure the Nasdaq versus M2 money supply versus its CAPE ratio versus commodities, gold, whatever it is, we're expensive, and most likely it's a bubble. So. Got some oil here. So Bloomberg reporting that Trump's team is preparing additional oil sanctions on Russia, Iran, and Venezuela. That is correct. And that's all we've got for today, guys. That's where I'm going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We're doing the question and answer session from 7 a.m. to maybe 10 a.m. Mountain Time. So if you're listening to this and you want to hop on, go ahead and join the call, and we'll see you there. All right, guys. Catch you later. This is Finding Value.